All right, well, in that case, let's go ahead and get started. Welcome aboard, everyone. Happy Friday. This is Ilian Yotov, founder of AllThingsForex.com and also a host of the popular daily All Things Forex broadcast. Please join me every Monday through Friday on my website, AllThingsForex.com, to listen to my daily outlook on the currency market. You can also check my book, The Quarters Theory, The Revolution in New Foreign Currencies Trading Method, available everywhere books are sold, including on FXStreet.com. And speaking of FXStreet.com, thank you to our friends there for putting together the series of webinars. Without further ado, let's go ahead and discuss what is going to be in the cards for the new trading week, February 11th to 15th. It's going to be another busy and interesting trading week, now especially that the euro has officially entered the currency wars. Well, if you're not believing that, all you have to do is take a look at what the statements were yesterday from the European Central Bank President, Mario Draghi. Although he said that consequences on the exchange rate do not reflect the G20 consensus, we will have to discuss this. And next week, one of the big events is going to be the Group of 20 Nations meeting, which the finance ministers and central bankers from the 20 most industrialized nations are going to convene next weekend in Moscow. And I would venture to guess here that one of the main topics that is going to be discussed is going to be exactly that, currency wars, the attempts from central banks around the world, at least from the major economies and governments, to weaken their currencies in order to spur economic growth. So that will be one of the events that we'll discuss. But first, we're going to start the list of the top 10 spotlight economic events that will move the markets next week with the Swiss Consumer Price Index, which is due on Tuesday. Many of you may not pay close attention to Swiss franc or Swiss economic data, which I wouldn't blame you for that. But if you have not been doing it, then it might be something to look into, because the Swiss Consumer Price Index trends continue to show the inflation gauge in deflation territory, and the forecasts, by the way, for next week's report are expecting for the gauge to decline even further. Now, this, of course, is the main measure of inflation preferred by the Swiss National Bank, and deflation has been one of the reasons why the Swiss National Bank had to resort to some of these unprecedented measures that we witnessed on September 6th of 2011. What I'm referring to is the Swiss National Bank, for the second time in its history, establishing an actual floor for the Swiss franc, the euro-Swiss franc exchange rate at 1.20 Swiss francs for 1 euro. That floor obviously has been successfully defended, despite of the attempts to break it and the pushes that we witnessed throughout last year by the market. So far, so good. The strategy looks to be working. And the Swiss National Bank is not going to be in a hurry to start tightening monetary policy anytime soon, or consider to remove the floor if deflation continues to be a problem. That's the biggest implication of the Swiss Consumer Price Index report, which is coming up on Tuesday. The forecast is expecting the inflation gauge to decline another 0.3% month over month in a month of January, compared with minus 0.2% month over month reading in the previous month. This is why I'm saying deflation is more than likely going to continue to be an issue. Therefore, I'm not expecting the Swiss National Bank to remove the floor anytime soon. Shortly after the Swiss Consumer Price Index, we're going to see the United Kingdom's Consumer Price Index, which unexpectedly rose in the previous month to 2.7%. This is where we're expecting the index to stay, with the consensus forecast expecting another reading of 2.7% year over year. This is a little bit far from the 2% inflation target, the desired inflation target by the Bank of England. However, not that far, and it's certainly not as high as the inflation level that we witnessed last year. At one point, inflation was above 5%. So we're in the target range between 1 and 3%, where most of the major central banks prefer to keep their inflation rate, which, of course, the happy medium of that is the 2% level. That's where they would like to see it. But as long as inflation is between 1 and 3%, I think it's within the desired normal ranges. Now, what's the implication of the Swiss consumer price? The United Kingdom's consumer price index? Well, obviously, if inflationary pressures start rising significantly, then that will be an obstacle if the Bank of England decides to consider more quantitative easing or any other kind of measures to stimulate the economy, which, by the way, there's a very real threat of a triple dip recession in the United Kingdom. Economic data has been disappointing recently, especially that we witnessed in the fourth quarter of 2012, the United Kingdom's economy returning back to a contraction after growing in the third quarter. Before that, it had 3 consecutive quarters of contraction. It returned to growth in the third quarter of 2012, and then conditions deteriorated again with the economy contracted in the UK in the fourth quarter of 2012. Now, all we need is the first quarter to be a contractionary type of a quarter. In other words, if the UK economy were to contract in the first quarter of 2013, then you'll have 2 consecutive quarters of negative economic growth, and what that basically is the definition of a recession, which in the United Kingdom is going to be a triple dip recession. And this is why on my program, the All Things Forex broadcast, and also in some of my outlooks, I have been saying that there's still a pretty good chance, whether they like it or not, that the Bank of England policymakers may have to resort to additional monetary policy easing, including another expansion, maybe another £50 billion expansion of their asset purchase program, and maybe even an interest rate cut of their benchmark rate, which is already at a record low level of 0.5%. But they could reduce it even further if, of course, the economic conditions continue to deteriorate, which all of these expectations, by the way, are going to weigh on the British pound. And as we saw the pound, we witnessed earlier this week, the pound was coming under pressure ahead of the Bank of England's announcement yesterday. Now, of course, the Bank of England yesterday decided to sit on the sidelines, and then the incoming governor, Mark Carney, who is the governor of the Bank of Canada, is going to become the governor of the Bank of England in June or July of this summer. He was not as hawkish on further monetary stimulus and cutting rates or expanding the size of the asset purchase program. So the pound took advantage of that for the time being, of course. But I think that if economic conditions continue to deteriorate and we end up seeing a triple dip recession, if the UK economy does contract for 2 consecutive quarters, I think that they will have no other choice but to do more easing. And as long as the market prices such expectations, then the pound could head even lower. At this point, the pound is bouncing off of the lows, and we'll take a closer look at the pound-dollar pair in a couple of minutes. The next report, number 3, is going to be the Euro-zone industrial production. This is also coming up on Wednesday at 5 a.m. Eastern Time, and we saw a little bit better than expected German industrial production with the report yesterday. The Eurozone industrial production is also expected to show a little bit of a better reading. An increase is the forecast of 0.3% month over month. Now, this will be compared with a minus 0.3% month over month in the previous month. So we're starting to see in some areas the Eurozone economic data is starting to improve, especially the forward-looking indexes like ZEW index, the IFO index have been better than expected. We saw a little bit of an improvement from the Purchasing Managers Index, but I'm not getting excited that much about that because the index, although it was a little bit better than it was in previous months, it still remained below 50, which is in contraction territory. And I'm not going to get excited about improvements in the euro area until these indexes go in expansion territory rather than staying in a chronic contraction, if you will, as I have recently also called it. It's a chronic contraction. It's been lasting for more than a year now in the services and the manufacturing sectors in the euro area. And we also know that the Eurozone is in a recession. So I don't think that it's now the time to get overly excited about the improvement in the euro area until the data starts showing. But for all that's worth, one of the positive reports that's expected next week from the euro area is to be the industrial production report, and that is due on Wednesday. Only 30 minutes after the Eurozone industrial production, we're going to see a very important report once again coming up from the United Kingdom. So needless to say, the euro and the British pound are going to be in the spotlight next week, along with the Japanese yen for the reasons I will explain later. Of course, the Bank of Japan's decision is coming up. It's a two-day meeting next week. One of the main events of next week is the Bank of Japan's announcement and the monetary policy decision. We also have a GDP report estimate for fourth quarter from Japan as well. So the yen, the pound, and the euro will be the three currencies next week that will take the center stage, at least for my personal preferences. The Bank of England's inflation report is a very important report because it offers an official analysis on inflation pressures, inflationary situation, and also economic conditions. And it provides also a further outlook on both, the outlook for inflation and the outlook for the economy in general. So it's a very important report to pay attention to next Wednesday, 5:30 a.m. Eastern Time. Obviously, as I explained earlier, if the Bank of England is expecting inflationary pressures to rise, and on top of that, the economy to start improving, then that could help the British pound because it reduces the odds that the Bank of England will be forced to do more quantitative easing or any other measures of monetary policy easing. If it's the opposite, however, the Bank of England is very dovish on its outlook, concerned about the triple-dip recession and so forth and so on, then obviously this would weigh on the British pound. So that would be the main implication of the inflation report. And as promised, let's go ahead and take a look at the daily chart of the pound-dollar currency pair, which in the recent couple of weeks has produced a strong bearish breakout below the bottom of the existing range for a number of months. The pound-dollar exchange rate was trading within a range roughly between $1.63 and then $1.58 levels. It was about 500 pips of a range with the low from November the 15th at the $1.5822 serving as the bottom of that range. Now, this is a range that we've been talking about for those of you who listen to this weekly Outlook webinar that I called every Friday morning for a number of months. So this is not new. And I believe a couple of weeks ago I even said that we should very closely monitor the bottom of this range because if the pound were to break it, that would be a extremely bearish technical development and it could open the door for further losses for the pound against the dollar. Well, that is what the pound did, and it broke below $1.5822 support, the bottom of that range, and it established a double bottom support here earlier this week at a little bit above $1.56 level, $1.5629, and then $1.5630, two identical lows there that were established on February 5th and 6th. So as a result of yesterday's decision by the Bank of England to sit on the sidelines while other central banks obviously are, like the Fed, for example, or the Bank of Japan, are pressing the QE pedal to the metal, as I recently called it, then obviously the pound benefits from such developments as long as the Bank of England stays on the sidelines, which I said earlier, I wouldn't be surprised if they are forced not to sit on the sidelines with quantitative easing, but for the time being, the pound is taking advantage of that, the fact that the Bank of England is not in a hurry to do more quantitative easing or ease monetary policy for that matter. So that's helping the pound, and we're now seeing the pound-dollar bouncing off of these lows, approaching what was previous level of support, now could establish itself as a strong area of resistance. The high today at the $1.5820 is hardly any coincidence. Well, it's a coincidence for someone who doesn't really pay attention to these things, but if you listen to this program regularly, you know that this was a strong support level, $1.5822. And on the way up now, the pound-dollar is testing that area. It's not breaking above it yet, so next week, if the pound continues to stay below $1.5822, then that would be a sign of weakness, and we could see the pound continuing to head lower after that. If it breaks above $58.22 decisively, then the pound would then simply re-enter its previously established range between $58 and $1.63, somewhat, well, not really in the middle of it, but the $1.60 level would be probably the next logical level that the pound-dollar pair could challenge after $58.22. Now, don't forget it may have a little bit of a resistance here at $59. A little bit before $59, we had $58.77 and then $58.91. Generally speaking, I would say that's an area around $0.59 that could be a problematic level of area of resistance as well for the pound against the dollar. So you have $58.22 and then $0.59 area serving as an area of resistance. If the pound manages to break above these levels, then $1.60 and maybe even $61, 61.5 could be in sight after that. Of course, that's the bullish for the pound scenario for next week. The bearish for the pound scenario, as I mentioned earlier, very easy to recognize, especially if the pound continues to have to be unable to break above $58.22. That would be a sign of weakness for me, which could signal that the next move is going to be more than likely another move lower to $56.29, the double bottom support, and potentially after that, even to, if there is a breakout below $56.29 support, we could possibly even see the $1.55 level. It's going to be important also the outcome of the Consumer Price Index report on Tuesday and the Bank of England's inflation report for the future trend direction of the pound-dollar currency pair. I'm expecting that we may see a little bit of a range-bound activity before these reports, and then ultimately, depending on the outcome of these reports, as I explained earlier, if they weaken the pound, then we could see the pound being pushed lower to $56.29, maybe even $55. If that's coupled with more risk aversion, equities under pressure, investor sentiment deteriorating, then that would be the type of environment that we could see the pound lower versus the dollar. If we get to see rising inflationary pressures, optimistic outlook by the Bank of England on Wednesday, more risk appetite throughout next week, that's going to be the favorable fundamental backdrop for the pound to continue higher, to get back in that previous range between $58 and $63, and possibly target the $60 level. Now, moving forward with the top 10 events of next week, we are going to also pay very close attention to there's two main spotlight events from the U.S. next week. The first one is going to be the retail sales report on Wednesday. It's always an important gauge of consumer spending. For the month of January, the retail sales are expected to increase by only 0.1% month over month. That's compared with a 0.5% increase in December. So it's not unusual for December to be a stronger shopping month, holiday shopping season and so forth and so on. So I won't be surprised. I don't think that it's alarming to see weaker retail sales in January following stronger retail sales in December and November. So that's the first of the two reports, and later on in the week we have the Consumer Sentiment Index, which is due on Friday, which we'll talk about in a little bit. Two of the main events next week, the Japanese Gross Domestic Product Report, which is going to be only a few hours before the Bank of Japan announces its monetary policy decision. The Gross Domestic Product Report of Japan contracted. The Japanese economy contracted by 0.9% quarter over quarter. In the third quarter of 2012, the preliminary estimate for the fourth quarter is expecting the Japanese economy to grow by a small amount, but at least growing by 0.1% quarter over quarter. Now, I, however, would not be surprised if we end up seeing the Japanese economy not growing, or at least staying flat, or maybe even contracting. in the fourth quarter. And if it contracts, so that'll be another quarter of a contraction. That means a recession in Japan, which will not be surprising whatsoever. I think that the risk with that report is that we could see a disappointment. And ultimately, if the Japanese economy continues to contract, then we could continue to see the Japanese yen staying under pressure because of expectations that the government there is going to continue to push forward with its aggressive measures to spur economic growth, to weaken the Japanese yen, to fight the chronic deflation there in Japan. And ultimately, the Japanese government would continue to put the pressure, political pressure, on the Bank of Japan to do all these things, to get even more aggressive than they currently are. And that's the reason for why the Japanese yen has been under pressure pretty much since November of last year. Very strong bearish trend for the Japanese yen. Obviously, many of you have seen, and we have discussed how strong this trend is. Here's the daily chart of the dollar versus the Japanese yen. You can see that the yen began that strengthening trend pretty much since these lows that were established in late September at 77.5 area. 77.42 was the low on September 28th, and we started the move towards 80 yen. We had a little bit of a pullback, and then very, very strong trend taking off, especially on expectations of the outcome of the Japanese election on December the 6th. We talked about that on the political change in the political landscape. All of the polls were suggesting that the new Prime Minister Abe and his party, the Liberal Democratic Party of Japan, is going to win the election, and so forth and so on. And then the pressure on the Bank of Japan will increase. There were a lot of promises, pre-election promises that are now being implemented, that the market's been pricing all of these expectations in the last several months, leading to an incredibly strong bullish trend for the dollar versus the Japanese yen. In terms of trend waves and trend progression, there's no better way to gauge the stages of the trend progression and developments, and we can all thank Mr. Ralph Nelson Elliott for that with his Elliott wave theory. I have my version of the classic Elliott wave theory, which does not limit the number of waves. In a classic Elliott wave example, as I have discussed previously months ago on this program, there's only 3 waves in the same direction and then a corrective trend wave sequence to follow. That is a perfect example as to why in my version of a classic Elliott wave theory, I do not limit the number of waves, because when you get to see such strong trends, you can have, and as I also show examples in my book, The Quarters Theory, I show an example in my Quarters Theory of 7 consecutive bullish waves following each other. 7 of them, not 3, 7. And this is a great example with the dollar-yen developments in the last few months, where we get to see 6 consecutive bullish waves without any significant major price correction taking place. In other words, in a classic Elliott wave pattern, you have the waves 1, 2, 3, and 4, with the waves 1, 3, and 5 being the waves in the same direction, and then you have corrective bearish trend wave sequence of waves A, B, and C. If one were expecting that corrective bearish trend wave sequence, they would have been expecting that sequence to start, waves A, B, and C, to start right around here when you have the 3 waves. Here's your wave number 1, wave number 2, wave number 3, 4, and 5. So here is where you're supposed to, with the classic Elliott wave pattern, for us to see wave number A, B, and C heading lower as a major price correction of that bigger, stronger trend wave sequence. Well, this is where a lot of classic Elliott wave traders would be in trouble, because as we witnessed in the days and weeks to follow, there were no corrective waves pattern, A, B, and C. It was simply a continuation of the bullish trend wave sequence. And so that's why I don't limit the number of waves. And we had 6 consecutive waves here. I actually don't even call the corrections following a previous bullish wave or bearish wave for that matter. These corrections here, I don't even call them an actual wave, because it's another way that I have designated with my version of the classic Elliott wave theory to focus really on the waves that progress the trend rather than regressing it. And I know that it may be sounding like a broken record because I've been bringing your attention to this in the last month or two on this program on a weekly basis, but I think it's a very good way to show you a real-life example as to what is one of the benefits of my version. For the lack of a better word, I call it the quarters theory trend waves, but it's obviously based in full credit to the classic Elliott wave theory, which, as I said earlier, there's no other better way for a trader to gauge the trend progression in the individual stages in each cycle of that trend progression than what Elliott has done with his wave theory. And so if you have to go with my version, you will see 6 consecutive waves. Here's wave number 1, correction following it. Second bullish wave, correction number 2 following the second wave. Third bullish wave, correction number 3 following the third bullish wave. Fourth bullish wave, then correction following the fourth one. Fifth bullish wave, correction following the fifth one. And the most recent one is the 6th bullish wave with the correction starting in the last few days following the 6th wave. Well, if they have to go with the example, if the market decides to go with the example I give in my book, we could see a 7th bullish wave if the yen, of course, stays under pressure ahead of the Bank of Japan's announcement. Now, earlier this morning, we had a statement in the parliament, if I'm not mistaken, by the Japanese Prime Minister or Finance Minister Taro Aso, who said that the pace of the recent slide of the Japanese yen has been too rapid. Mr. Aso said in the parliament that the Japanese government hadn't been anticipating a sudden move to around 90 yen per dollar. Well, you know, the move was very sudden. In a very short period of time, we actually saw the yen during the 6th bullish wave reaching as high as 94.05 yen. So they're trying to talk it down a little bit, I think also ahead of the G20 summit, because, as I mentioned earlier, that's one of our main events next week that we're going to watch, and we'll see whether the other G20 nations have something to say about the rapid appreciation of the Japanese, depreciation rather, of the Japanese yen, and all of the aggressive measures that the Japanese government and the Bank of Japan are actually undertaking in order to weaken their own currency. Which is causing, of course, the whole notion and the recent talk about currency wars. The French president earlier this week himself actually started talking about the euro exchange rate being controlled. Then yesterday, the European Central Bank President Mario Draghi said that if needed, they will have to review the euro value. Although he said that right now it broke. They would not to my daily broadcast, the All Things Forex program. All you have to do is go to allthingsforex.com and register as a member. It's free of charge, and you can listen to all of the archives available there. You can go back to the archives a few weeks ago. One of the programs that I had a couple of weeks ago was discussing the topic of whether the euro is now going to enter the whole currency wars movement, and I think the developments of this week are pretty much the answer to that question that I had a few weeks ago. So back to the dollar yen. This is going to be obviously a very interesting currency pair to watch. I would not exclude the possibility for the yen to stay under pressure ahead of the Bank of Japan, but also, as I also wrote in my outlook for FX Street this week, don't be surprised to see sell on the news or sell on the fact actual developments in the aftermath of the Bank of Japan's announcement, especially if the Bank of Japan does not give us something next week that we don't already know. In other words, the market's really aggressively been pricing in all of these expectations for aggressive quantitative easing, for new aggressive measures to weaken the yen, to stimulate the economy, to create inflationary pressures to fight deflation and so forth and so on. I think that these expectations, the majority of them at least, for the most part, have already been priced into the dollar-yen exchange rate. The dollar-yen pair looks extremely overstretched. It's a very, very strong trend, very strong bullish trend, but you always have to be concerned, and I consider that as a red flag when I see these overextended sequences of trend waves following each other. And we certainly have a great example, as I mentioned earlier here, where the dollar-yen is producing 6 consecutive bullish waves without any kind of corrective pattern following a bullish trend wave sequence. I think that sooner or later, in this case later rather than sooner, but sooner or later there is going to be a more significant price correction. And I'm not talking just a correction of 100 or 200 pips, as the recent corrections were. Every time we get to see these type of corrections following a previous bullish waves, we had a new buying interest resurging. I'm talking about a more significant price correction, a corrective bearish trend wave pattern in the opposite direction of these 6 bullish waves following each other. And sooner or later that pattern is going to come, and sooner or later that's going to happen, and we're going to see the dollar declining by more than 1 or 200 pips during that price correction. As a matter of fact, if you look from the beginning of that bullish trend wave pattern of 6 waves, when the dollar actually started strengthening from around, what was that area, 81.67, all the way up to 94.05, we have there almost 1,300 pips, a little bit less than 1,300 pips of a gain in a very short period of time. And up to 50% retracement of 1,300 pips. That means at least 650 pips, maybe 600 pips, to say the least. I think we could see that type of a price correction. If you want to be even more conservative, during such price correction, we'll probably see at least a move that challenges what I call the major large quarter point at 90 yen level, which is going to be 400 pips from the highs at 94.05. So that's the type of a more significant, larger price correction that I'm referring to, that I think is long overdue. The trend is strong, could remain strong. The yen could remain under pressure ahead of the Bank of Japan's announcement. But if the Bank of Japan does not give us anything that we don't already know, that hasn't already been priced into the yen exchange rate, then watch for sell on the actual fact type of moves, during which the yen actually strengthens. All right, so moving forward with the top 10 events of next week, following the the gross domestic product report from Japan, we'll see the Bank of Japan's interest rate announcement, which I already discussed. That's expected around midnight, could be a couple hours early, a couple hours later after midnight. The Bank of Japan normally does not give the actual time of when that announcement will come. So if you want to stay up that night, make sure to be on the lookout in a couple hours around midnight on Wednesday night, Thursday morning. Then on Thursday morning, we're going to see the second most important economic report of next week, which I have been expecting with great excitement building up, for me at least, because as I mentioned earlier, I did notice some signs of improvement in the Eurozone economy. However, I was not getting that excited about that improvement. Now, if you listen to European politicians, you would think that the Eurozone economy is booming. But in reality, as I mentioned previously, there is a chronic contraction in Eurozone's manufacturing and services sectors. There is also a recession there. And I still have not been able to see any kind of growth. In other words, growth remains nowhere to be seen in the Eurozone. Well, this is not the kind of environment that makes me, economic environment, that makes me very excited. And this is why, with great anticipation, I have been waiting for the Eurozone's GDP report for the fourth quarter of 2012. And the reason why I've been waiting for that is because we saw similar development in the United Kingdom, where there was a talk that after a double-dip recession, 2 consecutive quarters of negative economic growth, that the UK was going to return to growth. In actuality, it did not. There was a 3rd consecutive quarter of a contraction. And so, I explained 6 months ago that this is what I'm expecting could happen with the Eurozone. Well, we get to see a double-dip recession in the Eurozone, which we did. And I also said I wouldn't be surprised if we get to see, after 2 consecutive quarters of contraction, if we get to see the fourth quarter, another quarter of contraction in the Eurozone, which means exactly the same development that happened in the UK, 3 consecutive quarters of negative economic growth. And this is why the GDP report is, I'm expecting to confirm my forecast from 6 months ago. And it looks like the consensus forecasts by Reuters and other forecasters out there is pretty much in line with what I've been anticipating. As a matter of fact, the forecasts are pointing to an even larger contraction in the fourth quarter in the Eurozone than the contraction that we witnessed in the third quarter. In the third quarter, the Eurozone economy contracted by 0.1% quarter over quarter. The forecast for the fourth quarter is for the Eurozone economy to contract by 0.4% quarter over quarter. And this time around, the German GDP numbers are not going to be there to bail the entire Eurozone GDP reading, because they did that in the first quarter. German growth was stronger in the first quarter of 2012, which bailed out the GDP number from the euro area to not show the euro area in contraction. Now, this time it's not happening. The German GDP unexpectedly contracted in the fourth quarter of 2012 by 0.5%. That report, by the way, another reading is coming up on Wednesday morning at 2 a.m. Eastern Time from Germany, and it is expected to show exactly that, to confirm that reading, minus 0.5% contraction in Germany, and that, of course, is going to be a major drag on the entire Eurozone numbers, and that's the reason why we could witness the Eurozone in fourth quarter of 2012 contracting again, and contracting by a larger number than it did in the third quarter. Now, this is the kind of a report also that could weigh on the euro because, yeah, the European Central Bank president was optimistic, talking up the euro area, but talking down the euro. Well, when we see the euro area in the third quarter of a contraction, which to me is not going to be a surprise, but for those who haven't bothered to pay attention to the actual economic figures, it might be surprising. Unexpected contraction in the euro area. To me, it's not going to be unexpected. If it's a shock to some people, then, and if it's a shock to the European Central Bank, then obviously this could be a major drag on the euro next week as far as the economic report. It could really sour the optimistic mood towards the quote-unquote improvement in the euro area. And if the Eurozone contracts for another third consecutive quarter, we could see the euro heading even lower on expectations, which, by the way, is something that I've been also forecasting, that whether they like it or not, the European Central Bank could be forced to do more monetary policy easing, maybe even consider another rate cut from 0.75% to 0.5% in a benchmark interest rate, simply because if there is no improvement in economic conditions, if, as a matter of fact, they continue to deteriorate in the Eurozone, then they must consider doing something. And it certainly looks like the GDP numbers on Thursday for the fourth quarter of 2012 are not going to be able to instill much optimism as far as what's happening with the euro area. So, obviously, this could have a negative impact on the euro. Now, let's take a look at the daily chart of the euro-dollar pair quickly. We can see the euro being put under pressure here after a strong rally to a little bit above $1.37. On the way down, there was a range here between $1.3250 and $1.34 that the euro fluctuated for about a week and a half. The range was broken above. That was one of the main things that I said a couple of weeks ago we should watch. If the euro breaks above $1.34, I said it will then challenge the 2012 high, which was $1.3485, and I explained that if that high is broken, that's right there, that would indicate a significant bullish breakout, which could be followed by hundreds of pips of gains for the euro versus the dollar, and we certainly had a couple of hundred pips of gains after the breakout above $1.3485, with the euro rallying to above $1.37 level. Being put under pressure in a week recently, especially as the European Central Bank joined the currency wars movement and started talking down the euro yesterday, that certainly does not help. So the euro was put under pressure and tested the support at the $1.34 and reached today as low as $1.3359, which is an area of previous resistance, by the way. Let's see here that we had a little bit of a resistance here at the $1.3307. There's a cluster of resistances, or support levels rather, that the euro could encounter here in the area between $1.33 and $1.34. As I mentioned earlier, it was also a weekly range between $1.3250 and $1.34 that the euro has now re-entered, which is a range that has to be watched. The euro could just trail sideways within that range until we get to see the important report next Thursday, the GDP report from the euro area. But if the GDP report does not instill much confidence in the condition of the Eurozone economy, don't be surprised if at least the bottom of this range, which is the large quarter point to the $1.3250, I hope that you didn't think that $1.3255, the support from January 16, was a complete coincidence and serving as the bottom of this range. It was the large quarter point, an important level in my quarters theory there at the $1.3250, serving as a major area of support and ultimately the bottom of that range. So I wouldn't be surprised if the bottom of that range is actually challenged if the GDP report weighs on the euro next week. If the euro, however, continues to find support and stays at least above $1.3250, it could remain its bullish stance. It's been in a bullish trend here pretty much since the beginning or mid-November at least. This could be just a more significant price correction of the euro's gains before the euro heads a little bit higher. I think that if conditions deteriorate in the Eurozone, I think the market could get more aggressive as far as pricing expectations of more easing by the European Central Bank. But on the other hand, the Fed is way more aggressive with their quantitative easing actions, and it will ultimately depend on which one is the more aggressive between the two central banks, which I think that would be, the Fed will be the winner of that. The problem for the euro, however, is that we do have the Italian election, which is coming up on February 24 and 25th. And there's been the banking scandal with the Banco, whatever, Monte Pesci del Siena. I'm sure I butchered that because my Italian is non-existent, but it's the oldest bank. There's been some allegations there that obviously there's a bank scandal going on in Italy. Ahead of the election, Silvio Berlusconi is catching up with the in the polls with the leader in the polls there of the Democratic Party. So there's a potential for a hung parliament in Italy that will be unable to a party to gain the majority to put a government that's able to pass reforms, any future reforms and measures and so forth and so on. It's the same scenario that we've seen playing out with Greece ahead of the Greek election. So don't be surprised if that's a major factor that weighs on the euro going forward, especially in the days and weeks ahead of the election in Italy on February 24th and 25th. Moving forward with the top 10 events of next week, the second report from the U.S. that's going to be in the top 10 events next week is the Consumer Sentiment Index. It was revised a little bit higher than the preliminary estimate, and we're expecting for the month of February to see another improvement, a reading of 74.6 in the U.S. Consumer Sentiment Index. And the final event of the week is going to be the G20 meeting, which I already mentioned a little bit earlier as something to watch there. I really think that the G20 members are not going to be very happy with the current policies of the Japanese government and the Bank of Japan. It is not shocking to see the Japanese yen starting to strengthen ahead of the G20 meeting. It's not shocking to see the finance minister making a statement, as he did earlier today, that the decline of the Japanese yen has been too rapid. And in the aftermath of the Bank of Japan's announcement and in the days leading to the G20 meeting, I would not be surprised if the Japanese yen finds further strength versus the U.S. dollar or other major currencies that it has been declining against for the last several months. So I think that that's the main implication of the G20 meeting. Watch for the currency wars to be discussed. Watch for any kind of statements that would come with officials from other countries being unhappy about what is happening in Japan, the policies of the Japanese government and the Bank of Japan, which could weigh on, it could actually strengthen the Japanese yen, could weigh on the dollar or the euro and other currencies that have been strengthening against the Japanese yen. The G20 meeting is a 2-day meeting. It starts on Friday, February the 15th, and Saturday, continues on Saturday, February the 16th of next week. It's a 2-day meeting in Moscow. Now, this is all the time I have for today's program. Before I finish, I would like to invite you to join me daily on my website, allthingsforex.com, and listen to my All Things Forex live daily broadcast, 1 hour per day live analysis of the latest developments in the currency markets. You can also follow me on Twitter. At All Things Forex is the Twitter account. Thank you very much for attending the webinar today. Thank you to our friends at FX Street for hosting the webinar. Have a great day and a great weekend, and I will see you again next Friday.